Let's take stock of what the market texture is looking like. Kunal, hi afternoon. Another day of consolidation. What's in store for us next?
Yeah, so I think it's a different day of consolidation as such because today the pattern which we are seeing is selling in large cap names, which is quite prominent because I think many of the larger cap banking stocks, for example, are seeing a marginal bit of selling for themselves. It's not as if that the trends have changed for these stocks, but I think it's more of trimming positions back again into these names. The good part so far is that there is no major built-up of short open interest into either the index futures, both the Nifty as well as Bank Nifty, as well as on this large cap stock front. So that could probably be an indication that maybe this could just be a cutting of profit positions and trying to park money back into the mid cap names. Interestingly, today a lot of other mid cap stocks are also showing signs of momentum as well as volumes coming back. So my sense is that we could probably be in that transition phase back again, maybe some bit of profit booking in the large cap stocks for the next couple of days, and the money is shifting back towards the mid cap names.
Well, whoever said that it's done for mid and small caps, clearly not. But Kush, hi afternoon. A pointed question at that. Have we already seen the Santa Claus rally play out early December? Or do you think there's more upside to come at an index level?
Hi, first off, thank you for having me on the show. Well, I think it's done. And for a very clear reason. I mean, look at the kind of overheating that the indices have already seen. While I do see a lot of stocks performing and gaining momentum as Santa Claus Christmas rather approaches, but I think for the indices the major part of the rally is done. 21,000 has a very strong call base, will be difficult to take that out. 47,400 is a resistance zone for Bank Nifty. However, we still remain a little more bullish on Bank Nifty compared to Nifty. But yes, to answer that question very specifically, I think the major part of the Santa Claus rally is done. For the indices, I wouldn't be surprised. In fact, I'm looking forward to a dip of about 300 to 400 points on the Nifty. So the money that's all there on the sidelines could come in. But stock-specific action can continue. And as I said, a little more bullish on the Bank Nifty than the Nifty.
Very contrast views coming in from Kunal. Kunal believes that this is a regular pullback and this dip will be bought into, while Kush believes that bulk of the rally, Santa rally, is already in the price. Let's get a fundamental view also. Daljeet Kohli, head strategy at Vasuki India, is also joining us. So you are already, there's a reluctant smile on your face, Daljeet. Which side of the camp are you? The one who says time to book profits, bulk of the rally has already happened, or the side which says buy the dip?
No, see, we are fundamental investors, so for us, long term is always good, no? So we will always look for any dip as an opportunity to buy. We are very constructive on the market. We don't believe that the market run-up is over or anything of that kind. In fact, if you see Q3 numbers, they were very good. Q2 numbers, which were very good numbers. All the sectors have performed well. Hardly there was any sector which has given us a disappointment, except agrochemicals. I think most of the things have done very well. And there seems to be no reason to believe that this October to December quarter will not be as good. So I think fundamentally there is a strong reason for believing in India's story and the themes that are playing out. Yes, there are pockets where valuations have gone up much beyond their traditional way of looking at them. But then things are changing. We will have to live with the higher valuations also. Ultimately, valuations is just a game of perception. No? Whatever was good at 20 times, today even at 30 times, you will find it good because growth is there. So as long as companies deliver number, I don't think we have to worry too much about it. I think the space which we are right now looking at is pharma, where there are a lot of stocks which are giving good breakouts, good after a long consolidation phase. They're coming out of, and things have changed at their manufacturing sites. After 7 years, 8 years, some of the plants have come out of the US FDA issues. So obviously things have there is a lot more room to grow from there. So that space will give quite a few opportunities, I think.
Since you spoke of pharma, actually I was thinking of speaking with you yesterday because of this big 6% cut on DRL which came in. And this is one company which has hiked the guidance just a quarter back. Then on the other hand, of course, Macquarie came out today saying that these issues appear procedural and not very severe. But we are also talking about severe drug, shortages in US. So, do you think that pharma is a good space to get into? Any big fall over there should be a buying opportunity? Because otherwise, why would these companies hike their guidance in the quarterly calls, anyways?
Yes, in fact, see, the US business after almost 2.5 years of consolidation is coming out of all those problems. Especially in oral solid dosages, we have seen that the price cuts have now almost stopped. Some of it has to do with companies also getting into rationalization phase. Like, for example, for one particular product, if there were 10 manufacturers and there was a cutthroat competition amongst each of them, they have decided themselves to cut down. So some companies are out of those who could not manage the cost pressures, etc., they have moved out. So as a result, now there are only 2 or 3 players left. So that product rationalization has played out. New approvals are coming from US FDA. A lot of site approvals are coming. So new approvals are coming. And overall, the buyers, US market was highly concentrated with only 3 or 4 players who are buyers on the one side, and all producers are on the other side. Now, these buyers have also understood that there is only to that extent we can go. Beyond that, the producer will stop making anything. So all those things are now at a confluence stage, and that has helped in price erosion going away. In fact, in some places we have seen prices going up also. And many companies are now launching very prudently that instead of just going Me Too products, they're going for complex products. So there is a lot of thing which is changing on ground for US pharma business, especially the generic business and the complex business. So all these are top companies. They have very well accustomed to that. They've changed themselves. I think in last 7-8 years, companies like Sun Pharma, Dr. Reddy, they have made huge changes in their working style, which is now playing out. That's why I said that from here onwards, we believe that earnings momentum will be there for all these stocks. So with this, regulatory overhang will always be there. That is part and parcel of pharma business. That will always be there. And somebody might say that this particular observation is repetitive in nature, or this might escalate. All that is guesswork. Nobody knows what will happen because ultimately consultants will be hired. They will do the action for amending all these things. So I think companies are also well aware of that, and they are also taking part of it. So compliance is becoming a part of the regular business exercise now.
What's the opinion on IREDA though? Because it's already doubled in terms of valuation than its other listed peers, the likes of PFC, REC. Now it's quoting at triple digit, whereas the issue price just a few weeks back was only $32. Listed at 50, doubled since then.
I think that theme of renewable energy and anything to do with that is just playing out. Now the stock is definitely at irrational valuation, I would say. Its larger peers, well-established peers, PFC and REC are trading at lower valuation than this company. So this is probably just that the theme is catching on, and people who have not invested or who missed the bus in REC, PFC, they are looking for buying the third alternative has come. We were very positive. I think last time we spoke about this when it was on the verge of listing day, that we were expecting very good listing, but from there itself also it has doubled. So obviously the valuations are definitely not in your favor now. You are holding, the theme is working in your favor. So till that time that theme plays, you also stay with it. But definitely at some point of time, you'll have to book profit because valuations are definitely out of it.
In fact, the management, we just spoke with them earlier this morning. They're pretty confident of maintaining their asset quality, saying that they will not compromise on that front, specifically talking about the retail segment foray.
We have the risk mitigation plan in place, and we'll do deep down study, and we'll work out the economics also. Since we are a listed company, we have to ensure that our investors' wealth is also intact, and further sustainable growth is there. We want to now put in a focus and more professional approach, giving a focused and dedicated effort. So we'll not be compromising with our asset quality for sure, because that is our strength. The kind of corporate governance what we do and give, and already given in last 3.5 years, that has put put a stamp in the corporate governance for any kind of CPSE in the country as of now. We'll continue to sustain that kind of corporate governance, asset quality, and discipline within the organization. If you see, look at our book of September, 77% is private sector book. Despite that, we are having a 1.65 net NPA. And our cumulative write-off in last 36 years, just 203 crore against a total finance of 1,07,000 crore of, if you take September data. So we continue to maintain that asset quality. We are a corporate of Government of India, and it is Government of India's process. We are meeting all the criteria I have already said earlier, and we have given, and the meeting was also held. And I believe that the meeting was quite satisfactory. So since it is Government of India's internal process and decision, I will not prefer to divulge what we have discussed there. We are hopeful that the process will get completed soon.
Yeah, still talking markets with Nuresh, Kunal and Daljeet. Nuresh, you may have seen, Kunal, you may have seen SpiceJet news coming in, that the marquee investor coming in, this, that. And the stock, meanwhile, run up to this news has already done well. Now people are comparing that Indigo from 2200 went to 2900, 3000 because of low crude and improving load factors. All of that is okay. How do the charts of Spice look now?
Well, as of now, nothing exciting, Ajay, because the stock has not yet even crossed above the 200 DMA since the last 1.5 years. So entire 2022 and so far 2023, the stock has been reeling below the long-term averages, and I think that's one of the bigger concern for stock like SpiceJet. So I would still be a bit concerned into buying the stock at current levels.
Interesting. Avoid SpiceJet if you are looking at buying it only on this news that some marquee investors coming in, because stock has already run up in the last 3 months or 1 month period quite a lot, and the business is not exactly comparable to Indigo. They have the lion's market share, and SpiceJet still have a very marginal market share in the aviation space. The other stock I want to discuss is TVS Motors. Daljeet, they're thinking in the market that Ola Electric is readying for IPO. In fact, the news is that they've filed for a RHP with SEBI, and this will be the first auto IPO in 20 years. Last one was Maruti. And people are comparing the EV business of TVS Motors with Ola Electric, saying that it's already got 2/3 of what Ola Electric does. So why shouldn't one play TVS? Look at how it from 1400 to it's knocking at 2000 now. Does it still have value, or some of the two-wheeler stocks have value in them versus what's happening in the EV space? Because these guys also have developed their EV capabilities at least to half of what the bigger ones have.
See, TVS has proven itself very well in EV side. There is no doubt about it. When most of the existing players are still in that phase of finding the right business model, TVS has actually been able to prove that it is very well entrenched there. And as you said, in compared to Ola, etc., they are quite very much in their competition. So that means that they have a proven model and they are on the right track. Now, its question is whether somebody would want to go for Ola or will with the existing TVS Electric. As an investor, one would think about is that what is the runway to move from here onwards, right? Now, the runway for both the companies is very strong, because for EV we have hardly any penetration. There is still a long way to go, and as the time will pass, we will see that adoption of EV will increase only. With TVS, you will have a second advantage that there is other businesses besides EV, non-EV business, ICE's business, that will also continue to do well. So it's the comfort level which the investors would look at what valuation they would want to do. I think the stock has moved in anticipation of what is happening with Ola, etc. So obviously the entry point may not be a very good entry point at this point of time. And we are not, as a disclosure, we are not holding any of the OEMs in our portfolio as in auto sector, but we are very bullish on auto sector. We are holding some of the ancillaries. So instead of playing through OEMs, we play this sector through the ancillaries, and there are various ways of playing that ancillary through lighting business, through clutch business, so many other ways of doing that. So we are doing that way. But we think that yes, the sector is in for the good times ahead.
That's the take coming in on what to expect from the two-wheeler space. But let me just get back to aviation. And given that SpiceJet warrant issue approval which has come in, let me quickly take it across to my colleague Samir Dikshit and try and understand a little bit more about this. Samir?
So that's a big development for this cash crunch SpiceJet airline, that they have got a lifeline and they are able to raise over rupees to 2250 crores, over rupees 2200 crore by getting multiple investment from the investors from FII and HNIs as well. Now this more than 2200 crore will be utilized by the airline for meeting their financial obligations. What we are getting to know from our sources that this fund will be utilized to meet the obligations such as payment of salaries, revival of grounded aircraft and multiple others. Now this investment comes at a time when the airline was struggling to raise fund, and there are multiple dues which has to be cleared by the airline, not just to the airport operators, to the to employees, and also some other litigations in which the airline is currently going through. There was a board meeting that was done on December 11th, that is yesterday and today itself. So in the 2 days board meeting, finally it was concluded and unanimously the directors approved raising of the fund and the investment amounts to more than 2200 crores.
Okay, Samir, we'll leave it at that. That's what we're picking up right now in SpiceJet. Stock down about almost 8% as we speak. Let's just take a look at some of the other buzzers as well in the market and try and understand what's actually moving and not. I just want to pick up on some of the banking names. So take a look at what some of the private banking names are doing. Kotak, for instance, is currently down about 0.7%. Again, these are not huge cracks by any means. IndusInd Bank down 1.25%. ICICI Bank as well is a little bit soft. And HDFC Bank too is down about 0.6. And I can say the same about SBI too, down about 0.6 or so. Kunal, it seems like, while of course the Nifty Bank is pretty much mirroring what the Nifty is doing or vice versa for that matter, but does it seem like the Nifty Bank also has that kind of inherent strength? Because every fundamental experts we speak to, they're betting big on the underperforming private banking names. But are the charts telling you that they're going to, leap up forward from here?
Yeah, I think if you have a positional time frame, then of course I think these stocks should do pretty well for themselves. So, hardly or seldom is a rally for the indices where you see lack of participation for large cap stocks. Now, just take an example. For example, what happened to the IT stocks? The mid caps moved up first. Many of the mid cap stocks came back to the 2021-22 highs, and then now you're seeing the large cap IT stocks trying to chug along. TCS coming back towards a multi-month high. HDFC Bank, Kotak Bank from the banking pack, they were huge underperformers with respect to the other large cap private sector banking names. And especially the mid-cap and the banking pack, as well as the PSU banking stocks, large caps and mid-caps both. So there was a point where the underperformance was getting a lot more stark. What we've seen in the last 1 month, recovery for HDFC Bank, almost 150 odd points recovery for the stock. Kotak Bank has also recovered more than, I think, 150 odd points. It indicates that this is a strong positional recovery at play for these names. You may have few off days where these larger cap banking stocks, they may get into a mild correction as such. For someone who's bought at lower levels and is looking to have a time frame of 3 months or so or more, I think should continue to ride them.
One stock is actually showing a very peculiar price action. PI Industries. Pull up PI Industries. I've not seen such a big crack on that name on a single day in a very long time. 9.5% is what cracking in. We'll try to get in whether it's some specific news trigger which is initiating that kind of a move or something else. But Daljeet, PI Industries, some of the bigger companies out of the agrochemical or specialty chemical space, are there early signs that these are becoming buy candidates now, or you would still stay away from them because they have been underperforming for reasons of their own in the last few years?
So on agrochemicals as such, we are very positive. We believe that this sector is in the bottoming out phase. Now, it may take a quarter or so to actually bottom out, but we are expecting that the sector will start performing well in next few months. Why? Because the channel destocking, which has been happening for almost 2 years, is now coming to an end. There has been a lot of dumping from the China side also on because there was not enough growth in China post-COVID. So many people thought that once China will reopen, a lot of this consumption, they will have in-house consumption, and therefore the global markets will be spared. That has not happened, and in the last 1.5 years, we've seen these stocks getting hammered down because numbers were not coming. Even till last quarter, numbers have not come. And the channel checks and the management commentary, when we talk to them, they're also saying managements are also of the view that it will take maybe 3 to 6 months for things to come back. But ultimately, I'm drawing an analogy of this with the phase when we had with API business and intermediate business for pharma years back. No, post-COVID, similar thing had happened with them. And then because pre-COVID, most of the people had a lot of inventory, and because of uncertainty of supplies, etc. And then over a period of 1.5 to 2 years, that got dismantled. Finally, things came into shape. So same thing will happen with agrochemicals. It's a matter of time. It is not a question of if. It is just when it will happen. Maybe in 3 to 6 months, we are expecting. We are already holding 3-4 stocks in which are smaller stocks. One is a totally exposed to exports, and one is a combination of exports in domestic market, and another is a pure chemical play in India. We are not holding this name which you are talking. I think today there is some news flow about their main product being is getting some competition from a Chinese player or something of that kind. Is some rumor of that is moving around, but as very well established player of this kind getting disturbed by one more new player coming in or one more competition coming in, I think it's too much. Just that people are, because the sector headwind is there and this stock has performed well over a long period of time, maybe there's some kind of profit booking coming in. Agrochemical theme, we are quite bullish.
Agrochemical space stock, which hadn't taken such a big knock, all of them or many of them fell in the range of 15, 20, 40, 50% from the recent top. This one and SRF were relatively outperformers within that space. But today it's taking a knock on the fear that one of the key products of theirs may see heightened competition, which Daljeet was also alluding to. But let's gather some more details on those lines. Lisa, our analyst, is joining us who looks at the space very closely. Lisa, tell us, what's this issue which is worrying investors on PI? Lisa? I think,
right.
Yeah, go Lisa.
Right, so PI Industries is in focus today, and that is because Shandong Welfang Rainbow Chemical Company, which is based in China, the news is that they have received approval to construct a pyrazole less sulfone project. Now, this chemical that is very important for PI Industries because it occupies around 60% of the sales. Rainbow Agro, which is a multinational crop protection company in China, they have received approval for an annual production of around 2,000 tons, and Rainbow Agro, they have already completed 1, 2 and 3 product registration plans. Well, this is the third Chinese company which have announced a capacity for pyroxasulfone chemical, and Chinese companies, they have been launching and planning capacities before the patent has expired in Brazil and American region. So that is why we can see PI Industries, it's in focus today, and it has seen a pressure on the back of this news coming in. And well, BNK Securities have said that this is inventory issues is already there for agrochemical companies, and this China dumping that will add to more pressure coming in for the company.
So that is the thing which is worrying investors. One of their key products is witnessing heightened competition. So people are selling out of that stock or booking some profit. But Daljeet was telling you earlier, a company, such well entrenched company in that space, perhaps it will be premature to assume that their market share or business model will be completely shaken just because additional competition is surfacing on one of their key products. We'll try and get you the company as well on that one. But let's scratch that point a little more. You were saying the next 3 to 6 months, Daljeet, you were expecting a recovery, and you started, building position in agrochemical and specialty chemical, which were not, which have not performed last 3-4 years. Can you share the name which you added recently?
Ajay, due to compliance reason, I am constrained not share the names, but I can just tell you, as I said, that one company is purely into exports and very well known, very well tracked company. So I think you can guess that well. They have lots of registrations across the globe. And the other company is a domestic company which has 80% business domestic, 20% is exports. And then again, since the time of IPO, they've been adding the capacities, but those capacities were never utilized fully. So they have been not able to get the full advantage of all that investment. So we expect that investment will start playing out in next few years, and therefore the stock is available at rock bottom prices. So downside is limited there. The third company is a mix of agrochemical, basic chemicals, chlorochemicals, and some nano urea, etc. So it's a mix of all the things. If that
Really
gives you some
great to
hint
have
about
you
stocks.
on the show with us. Thanks as always for taking the time out. Appreciate you joining in. On that note, we're going to get in some closing trades as well. Kush, what's on your list?
Well, we've been discussing metals as a theme, and they have been doing well and continue to surprise on the positive side. So one stock that we've got on our radar is Jindal Steel. It was a call in our advisory service as well this morning. Just a disclaimer there. Jindal Steel continues to remain a buy. The targets here would be 755 and 770. 730 is where I would place my stop loss. So that's one stock that I've got on my radar.
Kunal, what about your closing ideas?
So that will be Bajaj Finance. The stock has been a big underperformer in the last 1 or 2 weeks, and I think the indicators have started to get into a turnaround mode. So expecting the stock to start to pick up pace from current levels.
Okay, on that note, let's take a very quick break. We're definitely at the session lows, but not quite down and out. We'll pick up the last half an hour of trade on the other side.